Our next guest says 5.3% could be in the cards. Ben Emons is a senior portfolio manager and head of fixed income at NewEdge Wealth. Ben, always good to see you.
Good to be back. Thank you for having me.
How long does it take to get to that 5.3% you think we're going to hit?
So it does look like we're back to where we were in the summer of last year. I remember that we had yields starting around 375, and there was a lot of supply coming in, strong economy. Everybody started to reassess the risk of bonds. We're today at 455, but the risk of bonds is again high. So yesterday, not only that CPI number being hotter, and that I guess inflation risk is underpriced, but we're dealing with a lot of supply, and we're dealing with a Federal Reserve that's cautious and has to maybe start shifting its message, saying we're not only staying on hold, but if we're dealing with more hot inflation, we're going to have to get ahead of it, right? So there's a lot of pressure under this market. So I think it could well lead to this 5% level that we saw in the summer of last year. Now, the technicals, as I've shown it once before, this Fibonacci chart from '07 till now, you know, we made really good support at 61.8 retracement, which was like around 3.5%. We're now above the 67% retracement, which is around 4.25%. So that leads you to the retracement of the top. The technicals, I think, have a lot of power here. So I do think it's possible to get to that high.
Technicals, without question. Tim has talked about that. But at 30,000 feet, understanding you're looking at the technicals, what do you think it means for the equity world if we get to 5.3%?
It means pressure, I think. I mean, it is a level of where Treasury yields become restrictive for the economy. Right? And I think that's the assessment for the stock market to say, okay, Fed, you having a 10-year yield the same as the Fed funds rate, that puts a lot of pressure on housing, that puts a pressure on industrials, on anything that's interest rate sensitive. I think that's going to be a bit of a problem for the stock market.
Ben, let me ask you, do you think we'll see something like last summer when we saw the quarterly refunding announcement, surprise to the upside, and then the cadence of how they would do it? Do you think we'll see see that show again?
To some extent, Karen. It was interesting. A few weeks ago, the Treasury Borrowing Advisory Committee, the TBAC, they had a presentation out on the deficit and what they think of supply. It was notable that they forecasted T-bill supply to decline, but all the long-term Treasury supply to stay the same, which is large currently. We, auctions of 40 billion to 60 billion. It didn't project more supply on the long end, but it definitely kept it the same while T-bill supply goes down. I think that's the tension for the Treasury market. If the refunding shows that they're scaling back T-bill issuance, the market's going to have to price in that term premium. That term premium, by the way, the Fed put out a model on this, is negative currently. That is not a good signal, I think, for bonds.
You talk about in your notes also the yen carry trade. And for people that don't follow this trade, help people understand the implications of this, but that you feel this is also another potential pressure on treasuries, effectively Japanese or anyone borrowing in yen and investing in U.S. dollars, especially the treasury market. Talk about that. And the move in the yen, which has been contrary to what people would have expected, right, with the end of negative interest rates in Japan.
Yeah, the yen going so quickly through 152, which was a little bit of a line in the sand. No liquidity there, so they're testing even higher now, 153. Last night, there was this comments out by this official who's actually in charge to, say to the BOJ, go ahead and execute, right? There's actually some one of those officials that actually said, like, we're pretty close to doing something, right? We're ready to act, and the market just ignored it and go higher. So as the yen weakens, there will at some point be this intervention, probably. But what you really are going to likely see, I think, is that this yen...
Selling of treasuries, though, to cover that yen short.
Exactly. You're going to see that unwind starting. Now, there's two parts there, Tim, is that you have the Japanese that own treasuries that are hedged to yen, but then you also have foreign investors who own Japanese stocks that are hedged to dollars. So I think there's a real tension here of like having a short position in yen with foreign investors, with the domestic investors in Japan holding long treasuries. So that's, I think, where, if we're getting this yen intervention, I think that's where there's a real pressure point for the treasury market.